All right, so if you could be a fly on the wall where the biggest names in crypto are talking, what do you think you'd hear? You thinking wild price predictions? Talk about Lambos? Nope, not even close. They're actually talking about something way more fundamental and, to be honest, a lot more concerning. So let's pull back the curtain and see what's really keeping them up at night. One word: risk. That's it. That is the single obsession that is consuming the builders, the engineers, the fund managers, pretty much everyone trying to build this whole new financial system. And when they say risk, they don't just mean Bitcoin is having a bad day. Oh no, they're talking about the actual foundations of the entire experiment. And look, to be fair, you can kind of see their point. Institutional investors, they're used to assets that have been around for, well, basically forever. Gold, it's got a 6,000-year track record. Real estate, we've been sorting that out for 10,000 years. And then you have crypto, building a multi-trillion-dollar system on top of concepts like oracles that are barely 5 years old. Bitcoin itself is basically a teenager at 16. So yeah, you can imagine why the old guard might be just a little bit skittish. So let's really get into it. What does this risk actually mean? Because it's not just one thing. It's more like a whole buffet of potential nightmares that could, and sometimes do, bring the whole system crashing down. Okay, first up, you've got platform risk. That's when you put your trust and your money in an exchange like Celsius or BlockFi, and then, poof, they go bankrupt and your money just disappears. And that leads directly into contagion risk, where one company's failure creates a domino effect, taking down a bunch of others with it. Then there's the pure technical risk. We're building on brand new, sometimes really fragile software here. And finally, you have these things called liquidity gaps, which is just a fancy way of saying the market can literally vanish in an instant. They have these, quote, ridiculous flash crashes where for a split second, there's just nobody there to buy or sell. The whole system is still just finding its sea legs. And hey, if you want a real shot of reality, listen to the analyst Willy Woo. He says the industry today, with all its billions, is pretty much at the same stage it was back in 2013 during that infamous Mt. Gox hack. The infrastructure is just that shaky. He thinks we've probably got another decade to go before things are really solid. It's kind of like trying to stream Netflix on the internet back in 1995. It's just not going to work that well. So if the whole house is built on shaky ground, what's the plan? Well, the industry is trying, frantically, to grow up. It's trying to bolt some old-school stability onto this very, very new-school technology. The strategy is basically a three-parter. First, and this sounds so obvious it's almost funny, actually build good products. Things that normal people can use without needing a computer science degree. Second, start borrowing some tricks from the grown-ups over in traditional finance, who figured a lot of this stuff out a century ago. And third, just build better, stronger financial rails, an infrastructure that can actually handle the pressure. And here's a perfect example of one of those old-school tricks. It's called a trilateral agreement, which is just a super fancy term for a very simple idea. You don't store your money at the casino. Your chips, or in this case your crypto, are held by a totally separate, trusted company. So if the trading platform goes haywire, your assets are safe and sound somewhere else. It's pure common sense, but it's only just now becoming common practice in the crypto world. Now, here's the irony. One of the biggest stabilizing forces in the crazy world of crypto isn't some hot new token. Nope, it's a digital version of the world's oldest reserve currency, the good old US dollar. Let's talk about stablecoins. Just to give you an idea of the scale we're talking about, look at this number. That's the market cap of just one stablecoin, Tether. $82 billion. Just let that sink in. It's this massive parallel financial system running entirely on crypto rails, but it's all priced in American greenbacks. So who's actually using all these digital dollars? Well, it's a tale of two completely different worlds. If you're living somewhere like Bolivia, where hyperinflation is destroying your currency, something like USDT is an absolute lifeline. It's a way to protect your savings when your country's money is becoming worthless. But if you're in the US, it's mostly convenience, a slightly faster, cheaper way to do a wire transfer. The same exact tool, but for wildly different reasons. And this gets to the dark, kind of uncomfortable truth at the heart of the whole stablecoin boom. This is straight from the CEO of Tether himself. He basically admits that his company's success is a direct measure of the failure of other countries' economies. The worse a government mismanages its money, the more its people need an escape hatch like USDT. He says it's almost sad. Yeah, you think? Okay, so we've talked about the risks we're dealing with today and the fixes that are in the works. But there is one more risk looming on the horizon, and it's a big one. This is where things start to sound like they're straight out of a sci-fi movie. So what happens when a computer becomes so ridiculously powerful that it can just break the encryption that protects every single Bitcoin wallet? This isn't really a question of if, it's a question of when. And believe it or not, the crypto world is already debating what to do when that day comes. So, in this crazy quantum heist scenario, what's the ultimate prize? It's the Holy Grail, the legendary, untouched wallet of Bitcoin's anonymous creator, Satoshi Nakamoto. We're talking about 1,000,000 Bitcoins, just sitting there, protected by older, more vulnerable encryption. It is, without a doubt, the biggest sitting duck in the history of finance. And let's be real here. This is not a job for some hacker in their parents' basement. The first ones to get their hands on this kind of godlike computing power are going to be global superpowers. We're talking the US government, the Chinese government, maybe a couple of those giant tech companies. They're going to be the only ones at the table capable of pulling off the heist of the century. So this all leads to this massive, fascinating debate. What should the Bitcoin community do? And there are really two main camps. Option one is the safe, sensible, responsible adult in the room choice. You release a software update that just freezes all those vulnerable, lost coins forever. Boom, threat neutralized. Option two is, well, it's the grab your popcorn option, the chaotic, entertaining option. Do nothing. Just sit back and let one of those governments steal Satoshi's billion-dollar fortune and see what on earth happens next. It's a truly wild game theory problem. And really, when you boil it all down, the risk, the solutions, even the crazy quantum threat, it all comes back to this one single, powerful question. At its heart, this entire crypto experiment is a bet. It's a bet on whether you trust the cold, impartial logic of mathematics more than you trust the flawed, emotional, and often self-serving decisions of human beings. And on that question, well, the jury is still very, very much out.